Perfect, then let's go ahead. Hello, hi, and welcome everybody. We've just had some issues around videos, microphones, and all of that, but I do hope and believe videos and audio issues should all be sorted by now. So welcome to the webinar on social inequality, how to tackle it, challenges, opportunities, and measurements way ahead. I'm Timo Pfeiffer. I'm your host today as CMO of Solactive. Greetings to everyone on the webinar. I think it's fair to say all over the world. Greetings from my home office, formerly known as guest room here in Frankfurt. Being joined by a great panel, which I'll introduce in a second. My two challenges today are: number one, try to stay on time. So we're scheduled for about an hour. We'll try to keep this. So it's a very interesting topic. It's a very interesting topic that will be challenge number one, to actually stay on time. Challenge number two, also on logistics. I will try to monitor, and I will monitor questions you may have. Feel free to post them through the chat function. And I'll also try to leave a bit of time towards the end to post questions directly to us. I'm being joined on today's webinar on this virtual panel. Let me start, that's from my perspective, bottom left, Kai Stievering from Flow Traders. I'm pleased to introduce Kai, who's sitting in Amsterdam. He's with Flow Traders since many years, I believe 2006. Kai is the ESG expert over there in Amsterdam with Flow Traders, and that's primarily and also through his exposure by focusing on the Nordics as a market where ESG, in the different shapes or forms, is of course very prominent. Kai is also a proud father of a first son since about a year, which has helped him to get through the pandemic and all of the mess we're jointly in during the last 12 months. I'm moving on to Alan from Climate Bond Initiative, close partner of ours on the, let's say, green investing, bond investing side, and some indices we have launched jointly. Alan is also a proud dad, but his sleep deficit is still significantly more pressing and newer. So believe me, it's a positive thing. It will stop, it will improve from here. Pleased to have you, Alan and Kai. By intention, and usually I would say ladies first, but intentionally did not do so, and have the pleasure to introduce you to Diana van Maastik, founder and CEO at Equilibre, also sitting in Amsterdam. As we just realized, she's actually sitting in the same building than Kai. It's about time that after this webinar, with whatever distancing, you guys probably grab a coffee, being that close together. Diana and Equilibre are very close partners on the whole area of ESG investing, ESG index creation, with a very strong focus on the S part of it, in particular gender equality, gender diversification, where Diana, I think it's fair to say that you're an absolute, well, advocate for sure, but absolute pioneer since many, many years on that front. I apologize, I have to make the usual joke that I have with Diana, which is she's a minority in the Van Maastik family, as much as I'm a male minority in the Pfeiffer family. So the combined families would probably be the perfect gender balance. But still, we prefer it to be that way, and it's a privilege to be in that minority. Let's move on and let's move over to the content and the topic. I'll admit, I'll share with you, I actually, believe it or not, did some sports yesterday. Cycling out in the forest, it's been a beautiful day over here in Frankfurt, and started thinking about the webinar and the headline just on social inequality. And it got me to reflect on the past 12 or now 14 months, anything that has happened and anything that has been influenced by Corona. The pressing topics just prior to this whole mess starting have been in ESG space, sustainability, clearly around climate change with those Fridays for Futures out on the streets, and if I move more to a social context, saying that, you know, climate is not a pressing and social aspect, we definitely had a refugee crisis, something we've put aside, and that's an example already if I think of social inequality. I have also looked on a positive sense in many, many areas where I think we have simply, by and large, in a corporate context, business context, in a person context, leapfrogged and jumped ahead in many areas and in many parts. Being on a Zoom call technologically is one of the examples, many areas that have definitely benefited and just jumped ahead and speeded up developments. I think, and unfortunately, looking at many of the progresses that have happened against social inequalities, many of the progresses that have happened over the last years or even decades in a social context have unfortunately suffered very strong setbacks and been unwound in certain environments. I had mentioned, you know, refugee crisis on back of inequalities. I can personally complain a lot about homeschoolings and the issues around it, but the honest truth is that you know, probably I'm well off, and probably and most likely and hopefully my kids are coping well with that situation. But they've probably also most likely been privileged to start with when I think of education, and many other kids did not have access to that education. That's true here in Frankfurt, that's true in Germany, that's true at worst in many other countries. So many of those areas, unfortunately, and on back of the situation and the pandemic, have suffered setbacks. How to deal with those, how our panel views those challenges, issues we have, also in the context, of course, looking at finance and investing opportunities and possibilities and accessibilities around it. That's going to be the topic over the next remaining 45 minutes of today's panel. I want to open up to you guys. I want to pass over to you with a bit of reflection from your perspective, where you think we have seen the biggest that I have just mentioned, setbacks, how to deal with them, what's been your personal experiences or perspectives, or probably, you know, the biggest concerns you have seen or witnessed and seen. I'm just going to start off, sorry, top left, Alan, why don't you go first?
Yeah, of course. Thanks, Timo. I mean, personally, first of all, you know, I'm based in London right now. You know, we have been working from home for more than a year. You know, it's been really tough. Personally, I mean, my background is, you know, originally I'm from China, right? So I was born there, raised there. I went to university there. I worked there, and then I moved to the UK. You know, 6 years ago. So therefore, I define myself as, you know, as a migrant worker. You know, by definition. You know, because last year the ban on international travel. You know, I still, you know, had family in China, my little kid, and also my family, my friends. I just couldn't, you know, visit them, you know, because of the travel ban. But still, when I saw, you know, some news, you know, on BBC, I feel like I'm still very privileged, you know, compared to other migrant workers, for example, in India, right? I don't know whether you remember the news, you know, from the same time last year, you know, when there was the first wave of COVID, you know, in India, you know, millions of, you know, migrant workers in there in India, they lost their jobs in big cities, and because the sudden lockdown, you know, measures rolled out by the government, they had to, you know, walk like hundreds of miles back home with, you know, very limited food and, you know, water. And actually, when I was thinking that, you know, these group of people are actually those who suffer from the inequality in the first place, right? So it's because, you know, they don't have access, you know, to, you know, clean water or, you know, local jobs. They'll have to, you know, travel, you know, to other places, you know, to work. So I think, yeah, I mean, it's very, you know, tricky, you know, when you think, you know, these are the same people. I think that's, you know, that what is called the Matthew effect, right, of COVID, right? So the rich get richer, the poor get poorer. I think that's, yeah, really my, you know, biggest concern, you know, when really looking into this real cases.
I think we all, in that sense, you know, most people on that webinar being in finance, that's probably privileged over the last 12 months in itself. that's a privilege by having a job, by working and, being invested, etc., by that spread becoming wider. Any other aspects that you have felt are particularly challenging or for the last year and a half?
For myself, or sorry?
Sorry, Kai.
Oh, sorry.
Yeah, something that we at Flow Traders always looked at a lot is how we can contribute to society. And when the pandemic hit last year, it's no secret that our firm was one of the firms that did well during that year as we benefit from increased volatility. But trying to give back to society, we were looking at different donation facilities that were available and where we can make a change. And we found that nothing was really resembling what is really important for us at heart. And so what we did is we founded our own foundation with the goal to fight poverty. And in this context, one of the areas we looked at particularly during the pandemic is education of children. And if you look at the numbers, only 1% of children of families that are below the poverty line have access to distant learning facilities. And this is something where our own foundation started making a difference by aiming to provide children from families that are not as privileged as we are here on this panel, access to distant learning, access to distant education, because the longer the pandemic goes, and we have seen that schools were shut, were partly opened again, the longer the depth that basically this situation builds on the next generation. And as you mentioned, I'm now a young father. For me, it's very important that my son would have access to education. And I think in our situation, we can provide it, but many other families, they don't have the luxury of providing their children with a secluded space to learn, with their own laptop, because realistically speaking, you cannot learn on your phone, you cannot attend school on your phone. And I believe this is something that I am and our firm is particularly concerned about in this space.
Diana, by no means I wanted to have you last again. I see you starting twice. I'm sure you have a lot to add there.
That's okay. I don't mind. I thought it was interesting also to hear what Alan and Kai have to say. And when Alan said privileged, I completely resonates by me. I think that I've been particularly privileged. I still have my job. My house is big enough that I have a place to work. My children are old enough that they can take care of themselves. But I think that when you look at the pandemic and you look at it with a gender lens, for the majority of the women in Europe and around the world, it has not been that way. I was looking at the numbers from the EU think tank, where they said that 76% of the people most exposed to the pandemic were women. And the reason is because women many times are overrepresented in low-paying jobs. Healthcare, childcare, cleaning, cashiers, retail, tourism, all of these areas have an overrepresentation of women, and these have been very affected by the loss of jobs and getting ill, also a contact with the pandemic. So that's one way that we really need to look at the pandemic with a gender lens. And then the other one is also what's happened when sending everybody to work at home under a lot of pressure. What we have seen in many countries is a great increase in domestic violence. And that has also been a problem and something that we can point to. And the last thing that I have seen that of inequalities and that have affected girls more than boys has been online violence. So now that so many children are online, predators have more access, and it's particularly the girls who are being mostly affected. So in all these areas, I think that to get us out of this, the solutions will also have to have a gender lens and address this carefully.
There's two things I want to comment on. The last one you've just mentioned, Diana, that's a personal one where I still have to watch that webinar on rules and behavior for kids on social media and online that I've promised to do, and the truth is I have not done it. Kai has brought up an interesting one that I just want to share. I read the book Scott Galloway, Post-Corona. I can really highly recommend. And in positive beneficiaries, he mentioned the big four around technology and whatever Amazon, Apple and the likes have achieved or accelerated there, but really the area with hopefully down the line positive impacts is around education and access to education. It's a, I guess, area and sector that's ripe for disruption anyways, with a broader access from primary schools up to the highest top class universities over in the US that is going to open up. So yeah, while in the current point, it is all more negative, like all the three of you have alluded to, there's hopefully also improvements further down the line. We've already also mentioned about the discrepancies around the wealth distribution and mentioning to finance. I want to take from the social lens one step back on the broader ESG scape, ESG investing landscape and flows associated to it. Statement that I think is fair and I've made many times is if I check my LinkedIn profile right now, ESG is the #1 trending topic. ESG in the different shapes and forms is the biggest topic and trend of them all. The momentum, the hype, if I call it, is up here. Very often, from my perspective, it's not matched, probably matched yet by the flows and the respective assets in ESG. I know with the different flows and assets and products you are involved in, you will have perspectives. So from an ESG financing investing perspective, where do you see the current status there before we zoom in closer on the social lens again, really ESG in general? Diana, feel free to go first this time.
This time I can go first. Well, I think the good news of the pandemic is that ESG is becoming much more interesting more people are interested in ESG. And we see growths in AUM. I think we want to continue to see the growths, but we do see a prognosis of growths in AUM, particularly for gender lens. It's expected that within 3 years, we will go from 3.6 billion to 30 billion. So that's a very good prognosis. And I think what's interesting is that we've seen that the pandemic has caused a speeding up of regulation and more interest by the investors. And this means that both together, we will continue to grow and see in the growth. I think one particular fund that we have worked the index together with Solactive on the gender fund of UBS, the AUM has now surpassed 660 million, and it's the fastest growing gender ETF out there. So that's really great.
On the two drivers of this trend and assets, you've mentioned regulation and you mentioned demand. How would you weigh the two, in particularly looking at that ETF of UBS? So is it all demand driven, or has regulation kicked in and played a role from your perspective there?
What I've seen is that it started with demand, and that the demand started to get really serious on ESG the last few years. And I think that now regulation, as usual, the governments and regulation is coming behind the market. But now that it's here, it's going to help to push it. It's really going to help to get it over the line.
Okay. Ellen, do you mind adding your perspective or views on flows? Obviously, you're more on the bond side, but I know you have a broader view on the market there as well.
Yeah. I mean, maybe two aspects. I think, first of all, a more broader picture. I think is, in this post-COVID, world, many governments are learning the lessons, to think or rethink, whether our economy as a whole is sustainable enough, right? So that's why you can see many governments, like, the UK government, the EU, South Korea, are rolling out this so-called, green recovery stimulus packages, policies. So this is a good opportunity, right, for the world to fundamentally restructure the economy, well, in certain sectors like, energy, transport, buildings, agriculture, to support the transition, from a more carbon intensive brown, economy to a greener economy. And of course, the green recovery is not only about green. All this transition has to be done socially inclusive. The purpose is also, to make this economy to be more resilient in general. This is, the broader picture. And on the other aspect is, from my day-to-day work on the bond side, CBI, Climate Bonds Initiative, we have been heavily focused on the green bond, analysis. But in the past 3 years, we do see a big surge in social sustainability labeled bond. Especially last year, there was a new label, pandemic or vaccine or COVID bonds. Well, many countries or many companies, issue such bonds, and we do see, there's a surge in this, labeled bond universe.
Okay, thanks. Kai, you are as close as it gets by definition to all the flows. So what's your perspective and observation looking at flows in general probably, and then with a more closer look at ESG related flows in my statement of, a lot of hype and definitely noise and momentum versus what's actually happening on the flow and investing side?
I believe what Diana and also Alan mentioned are, I think, very important factors here. And what we have witnessed in the last few months is the tremendous, maybe the biggest ever shift towards sustainable investing. Just to give you a perspective from our side, in 2020, approximately 40% of all the net flows we saw were already in ESG funds, and it was building up towards the end of the year. In the first quarter of 2021, it has grown to 60%. SFDR here in Europe, as Diana mentioned, from the regulatory side, has definitely succeeded in providing that regulatory tailwind to accelerate the direction of capital towards sustainable goals. But what I personally believe is that it simply has raised the bar. Previously, ESG strategies were something specific. It was an own part of the market, an own theme, if you want to say so. Now, more or less, investing according to social criteria and environmental and governance criteria has become mainstream. That means that now basically everyone will find it difficult to explain why not follow these criteria, and it has become a very specific mainstream investment. And from the flow side, I believe we have seen the picture that shows flows were directed out of core products into ESG, from core products into SRI, and this generally has raised the bar for investors. At the same time, it also means that strategies now have to start differentiating itself, both on the equity and on the fixed income side. And the forecasts on sustainable flows in general say that by 2025, approximately 53 trillion can be invested in ESG and sustainable products, which is basically 1/3 of the market. So the growth potential definitely is tremendous. When it comes to more specific strategies, and for instance, the gender ETF that Diana mentioned, since 2018, when it was launched at the beginning, we have seen a tenfold increase in activity, specifically in that product. So we do see investors are demanding these products more specifically. And I just read a study today where institutional investors were asked, what is the reason for investing in ESG products? And only a very small percentage said it is regulation. The majority of them say it's doing good and it's because we want to create value with that. That also means that thinking about the next stage, since ESG is now mainstream, those investors can think of, okay, what in addition to following the standard benchmarks can we do? Do we want to expose ourselves to more specific strategies like gender equality, follow other, say, United Nations Sustainable Development Goals? What is our own strategy in this specific example? And I believe SFDR, the regulation in Europe, has only provided a basic framework by having basically 3 categories of funds, Article 6, 8, and 9, whereas 8 is now the light green, the new standard, and 9, I believe, will be a more niche, more specialized area where issuers and product providers still need to grow into to satisfy the criteria. Nonetheless, we do see that the shift has occurred, and so far it is still occurring, and we have seen a very strong shift from core into ESG products and the reallocation of capital as the regulation actually has wanted to achieve. So I believe this is, for once, regulation well done in that aspect.
So here comes challenge number 3 for me today. Let me try to structure that, because you've touched on many different points. I would like to still stay on the flow and probably product classification side. You have mentioned twice regulation. We'll get there in a second, and particularly with the social lens on. We will also be looking at the different areas of E, S, and G and how they differentiate in terms of flows and what's needed. But on the product type, Kai, you have mentioned some areas there. You've mentioned core products, and you've compared what you have labeled core versus ESG flows. To what extent are those flows and products, and Diana's gender equality ETF is clearly a very focused and specific product, so it has a very clear intention. My view is still many of these flows basically are still core products, just dump a bunch of stocks based on some exclusion of controversial weapons and very fossil fuel, very fossil intense industries. So how do you look at the different products, not looking at them as a whole, but the different type of products within that, from being very specific with a purpose? I tend to call this ESG 2.0, and one of it is probably more core with a minor ESG overlay by just dumping a handful of stocks.
That's a very good question. So the basic, as you have described, this basic product is taking a standard benchmark, MSCI World, and applying an ESG filter on it, meaning that filter for specific criteria, controversial weapons, tobacco, fossil fuels. But at the same time, the objective is to stay as close to the standard benchmark as possible. These iterations can be repeated to a stage which used to be called SRI, where the exclusion criteria would be replaced with inclusion criteria, where the benchmark portfolio would rather be built bottom up as top down, but where also deviation between the SRI product and the standard benchmark would be, of course, larger. Those two basically ends of the spectrum used to be, say, the ESG universe last year, where it was from a light exclusion to a strong inclusion. In addition to that, you have products we would call, for instance, impact products. Gender equality is a very good example, which has a very specific subject and is trying to make a difference by promoting companies who do well in certain criteria. Under the new regulation, sorry if I touch this point again, these are all more or less so the challenge will be to go into that next bucket. Flow-wise, to come back to your question, the majority of flows have been in the light implementations of ESG, thereby basically following regulation, following the requirements that many asset managers now have. And in fact, we have seen some consolidation. After the regulation was introduced beginning of March, we have seen a few large asset managers moving from SAI, the strong implementation, into ESG core, the lightest implementation, because they see this as one bucket where they would like to be. And then rather replacing the more specific thematic exposure with specific products than the broader, say, SRI product, which is built on a more inclusive way of benchmark construction. And from the flow perspective, the replacement trade cycle, so the non-ESG into ESG, has mostly been directed into the light green, the standard ESG screened products.
And that's my view. There's nothing wrong with that. It's the obvious starting point. It's the start of that wave only becoming bigger and more. And it's a natural evolution, while the overall SRI part, as you have labeled or classified it, is and will be getting bigger and matches to Diana's predictions and statistics that or analysis that you have referred to.
The good thing about this is that the standard ESG, the lightest implementation, is not a standard, whereas before it was non-ESG at all. So I believe this is a very strong step in the right direction, and it's wrong to believe that light ESG means no ESG. It means yes, it is already included, and the fact that it is included on a very broad scale with lots of capital directed into this product means that overall the bar has been increased, which I believe is a very positive development of the market. And it still gives space to more inclusive, more thematic and specific strategies, which are still being developed as we speak.
Ellen, Diana, anything you'd like to add to Kai's perspectives and views?
No, on the flows, I think that he's right. I think what's interesting about the SFDR is that when you look at the 14 mandatory criteria for asset managers to disclose on. 9 are on the environment, but 5 are social. And I thought that when I saw that for the first time, I was very happy to see that it's that there's a balance there in how many are environmental and social.
Between you've already went into the environmental, social, and then of course governance, the different aspects or segments across ESG. I think fair to say that the environmental part, climate part in particular, is still driving most of it, still has highest focus or demand. But we are today on the EDS part and will be increasing that one. If I go back to the E, Alan, you've been very strong and launched a green bond index and have done a lot of research there. What's needed, what's missing to move to the S part, so to have the social bond equivalent. So what's the development steps or what's the status of that evolution from your perspective?
Yeah, so my understanding is these two markets, green and social, are becoming more interrelated. Well, yes, for the status of the social and the sustainability bond, market, they share some similarities with the green bonds, right? So if we look back to the very beginning of the green bond market, which was starting from 2007, the market was really dominated by development banks like World Bank, FC, and actually in the first 5 years of the market, it was purely development banks. And then starting from 2014, more and more corporates, both financial and non-financial corporates, came to the market. So the issuer types became more diversified. And then, the status of the social bond is sharing the same similarity, right? Because right now, when we look at the issuer types of the social bonds so far, it's mainly, again, FC, World Bank, EBRD, IBRD, ADB. They are dominating the issuance. But we do see we are going to expect to have more corporates to come to the market. I think that's the first trend, I would say. And then another, again, on the issuer types for the green bonds, we always encourage sovereign issuance as a demonstration issuance, right? So they can set the benchmark for other type of issuers, and they can show this commitment of the government, the national government. There have been more than 15 sovereign countries issued green bond, and the social bond market is picking up the pace. So, for example, Thailand, right? So they issued a sustainability bond with a green component and a social or COVID component, and we do expect to see more, such sovereign issues coming into this, social bond market. And of course, in terms of the market size, I think the number I can remember, if I'm not mistaken, as of the end of 2020, the cumulative issuance of green bonds reached to more than $1 trillion cumulative issuance. And only in the past 3-4 years, the cumulative issuance in social bonds or sustainability bonds, as a general, has reached to 500 billion, so half of the green bonds that reached in the past 10 years. So we do see a strong momentum in the green social bond, sustainability bond universe.
Jana, I know you are fighting and pushing very hard for that S to overtake the E. There's probably a very long way there. My question is also linked to obviously disclosure, transparency of ratings and criteria, where carbon emissions is just a factual and observable number, an easier metric to some extent, compared to many of the different aspects across the S, the social part. So where do you see the development there, or probably development and current gaps you're facing? Of course, you will know everything about the gender criteria and diversity criteria, but including that one, what about the others as well?
Yeah. Sorry.
Timo, I think we don't know who that question was for Alan or for me?
Feel free to pick it up. I was asking you, but Alan just jumped in, so.
Please go ahead, Diana. I can just add.
Now I forgot what the question was.
On the ES versus G side, across E, we agree strongest flows, strongest assets. To some extent, also easier if I simply look at carbon emissions as a factual number, but about the rating methodologies and also, let's say, consistency and transparency around the different matrices in the social part. What's needed, where do you see issues, what's the biggest gaps?
Yeah.
Including your diversity lens and beyond.
Yeah, for sure. No, I think for sure S still needs to catch up and develop itself as much as the E has been developed. But what I think is needed when I look at things that fall under the S, like, for example, the gender pay gap, we do need sort of one form of reporting on the pay gap. We are seeing now more and more regulation coming from different countries, the UK, Spain, France, and they're all putting forward a different way of reporting the gender pay gap. So I think that there it's really important to start to think that some way we need to have the same methodology and look at it in the same way. And I think that that's the case for anything, like looking at the supply chain and health and safety in the supply chain. What do we mean by health and safety in the supply chain? What is it that we're expecting companies to do in order to get a positive score on health and security in the supply chain? And we have to avoid some sort of, greenwashing of the social, which can happen also. And investors are increasingly critical of greenwashing, and we call it greenwashing, so we're thinking it's only environmental, but we still see that it's possible to wash out social issues. An example would be like having a fund that says they are a gender diversity fund, but they're only looking at women on boards in a company and whether there's 1 or 2 women on boards, and then they say yes, and then they say, oh, we have a gender diversity fund here, which is not the case. Many ESG investors who care about the S would look into this gender diversity fund and say, this is pinkwashing, if you want to call it that. And they would want to see a holistic view that takes, if you're going to call something a gender diversity fund, then you have to look at things like parental leave for women and men, the pay gap, supplier diversity, etc.
If I touch on that, and we just got a question from the audience, so a reminder to everybody, feel free to use the chat function, and it's directly related to that. Is the issue more about disclosure and transparency is important no matter what, or are you more urging for consistency in the way what's being disclosed? And the question here is particularly on gender pay gap. Yeah, so both. We have to start with transparency, for sure. We have to start with being able to publish something and publish some information. And then I would be for a unique, here they say a unique methodology, but I think it would be like a general methodology that can be followed across countries. And I would be in favor of having that, because otherwise transparency, even though it's good, it's not enough. But we personally, as of Equilib, we're not lobbying for this. That needs to come from the regulatory bodies. Okay, thanks. Sorry, Alan, I've cut you short twice. I'm sure you wanted to add to that.
Yeah, thanks so much. I just want to add on one thing, maybe also just to follow up what Diana said on the so-called social washing, right? Transparency is definitely important. And I do believe the transparency on the most relevant issues is equally important, right? For example, when we talk about greenwashing or social washing, I think there are at least three types of greenwashing or social washing. The first type is greenwashing or social washing by providing misleading information or even false information, right? For example, on the greenwashing, the company, if they say they use, I'm just making this up, right, 80% of the energy coming from renewable energy, solar, but actually they use 50% coming from fossil fuel. So that's a false claim. That's a fraud, right? So that's a problem for the company. And of course, when on social, the cases will be like something, if the company say there's no work-related injury in the past year, but actually they had a major, health and safety accident, and that's a fraud, right? That's a greenwashing or social washing by providing misleading false information. And the second type is, I would say it's a more like a materiality issue, right? For example, when I was working in China about, 10 years ago, when I started my career in ESG in China, and we were doing some research on the ESG reporting. Many banks in China at that time, they disclose their ESG performance on tons of water saved, tons of paper saved in their day-to-day operation. So, I mean, at this moment, we all know for banks, it's all the information is true, but it's not the key information they should disclose, right? For banks, they have the leverage. They should disclose more on whether they have, screening criteria when they do lending, whether they care the social and environmental controversies of the project they're going to lend money to. That's the key and the material issues, right? And I mean, we do see, many greenwashing or social washing by avoid talking about these key matters. And last but not least, which is probably the trickiest type of greenwashing and social washing, is caused by the discrepancies in definitions. Again, let me take for example. When it comes to hydro project, right? So people may consider, oh, it's green by default. Actually, it's not, because hydro with a reservoir can also emit a lot of methane emissions, which is very strong GHG factor. So that means they have to disclose certain threshold based on science, what is good and what is bad, even for a hydro projects. It's fine for green because it can be science-based. We have a target, we have a pathway. It can be calculated or estimated. But when it comes to social, it's so tricky. You cannot say, two schools, one in the UK, one in Africa. You can't really compare which is good, which is bad. I mean, I just want to echo, there's no consistent way of looking at the social criteria, the social taxonomy. So that's why sometimes people may claim, if you build a private school or private hospital in some countries, it's social washing. But I don't have an answer. I mean, may just leave the question to you and to the floor to the audience. For this type of, social washing or greenwashing, I think the only solution will be, having some taxonomy or criteria in place.
I mean, Seeing Red discussed a lot about greenwashing, the concept of social washing, relatively new to me, or that I've heard about it. Any other criteria you think could play a role there, or that probably differentiate between what you've just said already, between green or social washing? And Alan, you have mentioned regulation to potentially play a role to stop that, prohibit that. First step, probably measure that. So what else do you see as differentiators or ways to go in order to ultimately, of course, avoid any sort of green? I understand social washing is probably always for sure newer.
Yeah, I mean, many market players have a role in this, right? I think regulators might have the biggest leverage, because the problem was really caused by the fact, every company or every issuer of the bond, they have their own narrative of defining the thing. I mean, look at green, right? The EU taxonomy thing is the best example, right? So we have a common language, produced by the government, by the regulators. So therefore, if it's being made mandatory, it's even better, right? So people have to speak the same language, which is great. Of course, other organizations like, ICMA, the International Capital Market Association, they're doing a really good job on developing SBP, social bond principles, sustainability bond principles, which is great. And also CBI, we have been also doing some work, try to, shift this language or, build criteria to understand from also investors' perspective, what are the key concerns for some certain projects.
Okay, that also both of your answers actually, or responses and comments, have links to regulation, urging for regulation. Kai, you have mentioned a couple of times earlier on regulation, SFDR, Article 6, 8, and 9, clearly playing a role there. If you had a, let's call it wish list, call to Brussels, what's needed for us to make real progress, to have it better comparable, more broadly accepted? If I think of particularly social inequalities in an investment context, what would be the wish list? Or in other words, what's there that you view already as steps in right directions? Kai, you have mentioned, you've touched on that, you've started with that. So why don't you go first?
Yeah, so I believe it is a first step in the right direction. So what the regulation clearly mandates is that products need to report on their impact. They need to have a benchmark with very clear goals and targets. And if you look at the existing, say, thematic equality products out there, they don't qualify for the highest category Article 9 yet, because when they were created, they were based on benchmarks that doesn't basically incorporate this clear goal setting, impact, measurement, and reporting on it. So this goes back to what Jana and Ellen have said, that transparency, which in this case now comes, or is mandated top down, is something that really sets it apart going forward. And if you ask me about the wish list, is that these products will evolve into products that cover a broader range of sustainable topics, particularly on the S and on the G side, which are based on clear criteria that can be measured, ideally with a common methodology, as Jana has pointed out, on the gender equality side, on the pay gap side, and where investors can really see, okay, this is the product that I can invest in. This is where I will be making an impact. And finally, I can also report back to my clients, to my investors, that my portfolio is making a specific impact in different categories and what has been achieved. And I believe this regulation, which is very strict on the target setting, on the impact measurement, is the right step in the direction. And the products we have seen so far mostly focus on climate action, right? Because here, carbon emissions is something that is heavily discussed, that is measured already, where impact can be made, can be measured, can be reported. That's the reason why we have seen the first products into this high Article 9 category being launched based on Paris aligned benchmark or carbon transition benchmarks, because these are already there. And I would personally hope that more products into a more diverse set of S and G criteria will emerge and will allow investors to make that specific investment into specific exposure to make an impact. Because as we have seen, the values are more pressing and the demand is more created by values and the need to go good rather than the mandation by regulation.
Okay, thanks, Kai. Jana, it's your chance to call to Brussels, the chief lobbyists over there, the chief lawmakers. What's the list?
Oh, I have a very clear wish list for sure. And it has to do with transparency. You know, I work for Equilib and we research more than 4,000 companies every year. And one of the biggest problems that we find is the lack of publication. So I think when I think of my wish list and what I would want Brussels to tell companies that they have to publish is, first of all, they have to tell us what their gender pay gap is. What's their pay gap within their company? What's the average salary that women get in their company and the average salary that men get in their company? And that's, you know, it's very easy. All their HR departments have that. And I think that that needs to be published. If I can extend my wish list, then that published also at 3 different levels. But as long as they start publishing, I'm happy.
I know you won't stop. Yeah. It will be fine. With transparency is a great way forward.
At least the overall pay gap. I would like to see it at 3 levels, but at least the overall pay gap, gender pay gap. The second thing is I would like the companies to be forced to publish their gender composition throughout their companies. I can't tell you how many companies do not publish how many women work for them, or how many of them are senior managers, or how many of them, you know, they only put the board because they have to. But if we need to know at different levels of the companies how many men and women work there. That's what I would want to make obligatory. And the third thing is Definitely that they publish their policies that try to fight discrimination. And so what does the company have? Do they have an anti-sexual harassment policy? What kind of policy do they give for fathers or for parental leave, and for mothers for pregnancy leave and maternity leave? So yes, those would be the three things I would want.
Yeah. I think my view on it, and also comparing it a bit to what's happening on the climate side, is probably not necessary to be enforced through regulation. I'm just thinking I'm the investor relations guy at a company, and I've received, the 50th question on my... Great, perfect. Here we have the disruption that we've talked about earlier. It's not my kids. It sounded like a dog. Perfect. So my comment is, if I'm the investor relations responsible and I've received the 50th question on, hey, what's your CO2 impact and emissions, I start publishing it on my website. And the same, so more demand driven and enforced rather than some, a rule coming out of Brussels or somewhere, is going to happen if I've received those distribution of gender across different ranks in the firm overall, including pay, that more and more companies will be publishing that. I hope, I don't know, I haven't checked.
You're absolutely right. We started collecting gender equality data in 2017, and the data that we have today is much better than what we had there. Companies, we've had companies also say, I didn't know that investors wanted to see this data. But the more that they know that people want that data, that there's investment funds which are including that data, the more that companies will make transparent. They are moving, they're just not moving fast enough.
Okay, fine, understood. And again, the comparison like on the climate side, the same. So Alan, I know regulation, very important topic. I've stopped it twice, we have touched on it, so now's the time. Any comments or additions you want to make to what Diana as well as Kai have just said?
Well, I would say first and foremost, transparency is key, which is in line with what you said. As a DR, I think Article 9, I do see this is very important, right? So it applies to the products targeting, sustainability target. Right? So when we say target, definitely like Kai said, we have to measure, what's the impact and how we achieve the target, right? So that means it will push people to think how to measure the impact, what are the metrics, and then again, we were able to see the so-called taxonomy will probably just come out naturally. And so this is my thought. And again, because I'm also coming from this, green aspect, in the ideal case, I would say, I do want to see the regulators to give more push on disclosure on the social impacts for green projects, and then the green impact for the social projects. So let me give you two examples maybe. So when, again, I'm taking hydro, right? So when you build a green project with hydro, you have to see your negative social impact controversies, that's for sure. But on the flip side, when you want to finance let's say social housing, you have to consider having a green building is an option. I think disclosure on that, why people made the choice not to finance the building as a green building, or what are the alternatives and why they choose this, can be something, investors want to see, right? For example, in the green building case, the green building means the building is more energy efficient. Being an energy efficient building means the residents have lower costs, running costs, right? So they pay less on energy bills, water bills, for example. So again, you can see this loop, right? So green social can have a green component. That green component can feed back to the social, aspects. So this is my thinking about the ideal case. Regulators should push this disclosure.
So let's hope we have many of them on the webinar. Let's hope many of them will be listening afterwards to the recording. So the one big shout that we have is transparency, more push requirements towards better transparency, granularity, I think I should add, to data. I actually have a chance to finish on time. I actually have witnesses that I don't overrun, which is great and good for once. Still, I want to do a last round with all three of you. I have started off with a bit of a perspective back over the last 12 and 13 months, 12 to 14 months. I have mentioned some setbacks that we have suffered. Now I want to take a look ahead. Let's think of the year ahead and the headline of social and inequalities in general. What do you hope for? What do you think? What do we see where we are comfortable and you hope for the biggest progress and what's needed there? It can be personal perspectives, it can be finance, investing perspective, flows. Like I said, more personal and private environment, really anything. So what's ahead in the next 12 months? Visionary, wish list, or rather more of an evolution? Who wants to go first? Feel free.
I believe COVID has brutally exposed the shortcomings in terms of equality, right? And at the same time, this gives us as a society the chance to tackle these. We have seen that we have not only regulation, but only many initiatives happening in that space. And I wish that people make use of them. It's only visible if it happens, if it is being tracked, if it is being followed. And, we are very quantitative, so I always keep banging about transparency and numbers. But if this is really important, that there is some accountability for it. At the same time, we already do see that, for instance, investor preferences are changing. The next generation of investors is investing very differently than the previous one. And topics of ESG and furthermore are becoming important to them, for some even more than return. So I believe this is something that is a chance for us as a society to do better in the financial market going forward. And that would be my vision for the future, that we have learned from the shortcomings, from the inequality exposed by COVID, and build the next world, or the future world, a better place.
Perfect. Thanks, Kai. The future world, a better place is almost a perfect closing statement, but let's give a chance to Ellen as well as Diana as well. Diana, you want to go?
Yeah, I don't think I can do better than Kai. I think he said it very well. And so I will second that and apologize for my dog that had to bark in the middle of our presentation. These are part of the challenges of COVID, working with COVID. But I think that, I hope that what Kai has said happens. I think that, the inequalities have been made very clear. And we see now more and more of an interest, and money can be used for good. Finance can be used for good. So no to greenwashing and to social washing. And I would want to say yes to pushing forward an agenda of a better world for everyone.
Thanks, Diana.
Yeah, to me, first of all, I hope to see all these, 500 billion worth of social sustainability bonds issued can make real impact, especially those vaccine bonds. Hopefully, the COVID can be just, over very soon. And secondly, I hope many economies around the world can take this opportunity to have a green recovery, also to make the whole economy to be more environmentally, economically and socially resilient in the future.
Perfect. Ellen, Kai, Diana, thank you very, very much. Thank you very much for joining today's virtual panel. I am looking forward to having that properly, physically, having it in our offices, having you guys over. I hope that's one of the wishes we get there soon again. It's been a pleasure. It's been pretty diverse on the different topics around social inequalities. I'm sure we could go on for hours. A big thank you to everyone that has joined us on this webinar for listening in. Feel free in the aftermath to drop your questions and share it with us. In case there still are any, feel free to follow up with really any of us. It's been a pleasure today from Frankfurt for, Series 2 of our spring ESG webinar series with more to come. It's all online. You'll find it on LinkedIn. You'll find it on our website. So happy to welcome you for the follow-up sessions as well. I'll conclude and finish here with a big thank you to all of you. See you safe and healthy next time. Ciao.
Yeah. Thanks everyone.
Thank you very much. Goodbye.
Bye.
Bye.